More on the employment picture and a look at the energy industry. We are joined this morning from Oklahoma City by John Richels. He's the president and CEO of Devon Energy. Devon Energy is one of the largest independent U.S. energy producers, and also still with us, of course, is former Treasury Secretary and the former Alcoa CEO, Paul O'Neill, bringing back some of your corporate experience into this, Mr. Treasury Secretary. Now, let me first start with John, though. And, you know, it's a question that we've often asked to other CEOs, John, which is, what do you need to see in order to start hiring again or to hire more?
Well, as you know, Betty, this is an industry that hires a lot of people. There are about 10 million people that are directly employed by the industry, and actually it's one of the industries that's continued to hire some tens of thousands of people through the last couple of years of financial uncertainty. But what we need more than anything else, you know, we deal with some uncertainties in this business, the principal one being commodity prices, which naturally fluctuate and tend to be volatile, but that's something we can handle. What we really need is we need certainty in our fiscal and regulatory regimes, and you know, that's one of the areas that we've had some uncertainty recently. We haven't got a well-developed energy policy in the country, and the president from time to time has, even recently, has continued to talk about increasing taxes on this industry, which reduces the cash flow that we have in order to invest further and to continue to grow our business, and has also instituted and moved along a number of overlapping regulatory areas that cause further delays in the business. So what we need is some certainty from the political and fiscal and regulatory side.
But John, is there at some point, though, where that uncertainty will get put aside and you will start hiring simply because the economy is improving, the oil price goes up and up? I mean, is there some break point there?
Yes, I mean, obviously, with higher commodity prices, it provides more cash flow for this industry. You know, this is an interesting business because the independents in this industry, as you probably know, routinely invest 100% of their, or more than 100% of their cash flow. So in other words, they invest all their cash flow and they supplement that with debt and equity as well. And so naturally, as prices go up, that provides more cash flow and allows more activity. There are a couple of competing factors there, though. One of them, again, as I said, is the uncertainty of taxation and regulatory effect. The other is that once oil prices get to a certain level, you start to see some pullback or some demand destruction, if I can call it that, around the world as oil prices start to take a bigger and bigger piece of GDP. So that's kind of the offsetting item that we have to think about.
Right, and that's what economists are concerned about, is that demand destruction. John, just hang on. Let me just ask the Secretary here, because you know, hearing what John is saying, if you were back in the administration, back as Treasury Secretary, how do you alleviate a concern like that is so wide-ranging, which is taxes and the energy policy? How do you alleviate that and to get them to put cash to work?
Well, you know, in a way, I have to smile a little bit, because as I think back over the last 40 years, there have not been very many times where we didn't have exactly the same set of concerns, and yet our economy has doubled, tripled, quadrupled since, say, 1970. And so, in a way, I think the uncertainties attendant to regulation and laws and the like are always there. You know, my view is companies hire people where they have clear indication of rising demand and an ability to earn a competitive rate of return on the capital you employ. And so while, for me, a lot of this stuff from an individual CEO's point of view is background music, and it's often unfortunate background music, but it didn't really much affect what I decided to do and how we moved at Alcoa when I was the chairman of Alcoa. If I may, I'd like to ask John one question. John,
please, go ahead.
You know, what do you think of the materiality of what's going on in the Middle East to your energy industry? How much are we at risk, and what are the proportional numbers?
Yeah, well, that's a great question, you know, and it's a little hard to answer that, but let me try to quantify it a little bit. Certainly, with the unrest that we've seen in the Middle East and North Africa, that has caused a geopolitical premium, if I can call it that, to be injected into oil prices. Libya represents about a little over 1.5 million barrels a day of production. I think it's about 1.6 million barrels a day. And prior to that unrest, we had about 5 million barrels a day of excess capacity in the worldwide oil markets. And with the reduction in oil production both in Libya and Egypt, right, the Saudi Arabia, which is the second largest producer in the world next to Russia, I guess, has been able to take up some of that slack. But that continuing unrest and uncertainty is something that causes markets to be a little bit skittish and is creating some of this additional premium that we see in oil prices. We think that that's probably somewhere around $10 to $20 in oil, in the oil prices, depending on whether you're looking at WTI or Brent.
Well, John, how long do you think these oil prices will stay at this premium level, or how long will it stay elevated?
Yeah, it's hard to say. I mean, it'll probably take some time for stability to come back to the Middle East, and that is of some concern. Again, we don't have good, solid numbers around this, but there's a lot of evidence to say that once oil starts to trade in the $120 range for a sustained period of time, we do start to have a demand pullback or demand destruction, because a larger portion of GDP is taken up by energy prices. So, it's probably going to go on for some period of time, but if we get some stability in that area, we'll start to see prices come back down. On the fundamentals, it shouldn't be trading where it is today. We think it should be trading more in the range of $75 to $90. 75
to 90. Okay, John, thank you. I appreciate it. John Richels, the president and CEO of Devon Energy.